Hello and welcome to lesson number 4. Today we're looking at the mechanics of price movements and pattern recognition using the main dashboard. So this is going to round up the first phase of the course, looking at the bigger picture, the core fundamentals of currency trading if you like, and then tomorrow we can move into phase 2, which is looking at the core volumes and the bid and ask indicators to really pinpoint the most accurate money making conditions. Specifically, what I want to show you today is how customer orders and market maker orders interact and result in the mathematical fact that prices are more likely to move in one direction rather than the other. And this is a provable and repeatable market condition that can be used to predict price direction with 81% accuracy. And with that in mind, we're then going to look at everything that we've covered so far and walk through the process of analysing and interpreting the information that we see on the dashboard, so that you can pick out these high probability situations, and then that'll give you the green light to zoom in on the core volumes and the bid and ask indicators on the best charts to trigger a potential entry. So let's just jump into the mechanics of buyers and sellers coming together with real orders. Our starting point is the market maker, because they quote the prices that we can trade at. They announce a bid and an offer, which is literally saying how much they're prepared to buy or sell and at what price. Those types of orders are visible for everyone to see, and they're called limit orders. They sit in the market waiting for someone to accept them. Then we have the customers, the biggest and the most prolific of whom are the bank dealing desks, as you know. Customers use something called market orders, which is effectively just a type of order which, for the purposes of keeping the market functioning in an orderly fashion, say, yes, I accept the price that you've quoted and I would like to trade with you, please. Let's say this is what the depth of market looks like. Market makers don't just submit one bid and offer, they may submit lots of them at different prices. And of course, there's more than one market maker. So we're actually having multiple quotes from multiple different market makers. And you remember from the last lesson, this is called liquidity. So we have a customer A who wants to buy 1 million and customer B who wants to sell 1 million. Trader A's market order takes the liquidity or the offer here. So that quote is removed. It no longer exists. Trader B does the same thing when their market order takes the liquidity at the bid. As a result of those orders being removed from the market, the spread actually widens, as you can see there. What would happen then is the market makers would submit new bids and offers to fill that gap. That is literally a gap in the market, and market makers would compete for that space and put the best price they could in there. Now let's have a look at a slightly different situation. Trader A is coming in with a $5 million order. Trader B only has $500,000 order. When Trader B submits their market order, it only takes half of the amount that is available at the bid. So the price won't change. The quote will change from 1 million down to 500,000, but the price level stays where it is. The market maker is saying they've still basically got 500,000 that they're prepared to buy at this price if another customer wants it. But when Trader A submits their market order, it's bigger than the liquidity that's on offer. Demand exceeds supply. So it takes the 1 million here, then the next million, and then the next, and so on, until the trader has bought the full 5 million that he wanted. So as you can see, the price has moved up, but not down. The liquidity on the bid side was greater than the demand from that customer. So the customer's order was simply absorbed by the liquidity and the price didn't move. But the liquidity on the offer side was less than the demand from the customer. So the customer's order ate through multiple different levels, and that can move the price pretty quickly. So it's basically supply and demand, as I've said, and it gets very interesting in just a moment with perhaps the greatest edge that we can ever find. But let's just quickly look at one other scenario first. Trader A and Trader B are now back with equal sized orders, but this time the liquidity on either side of the market is different. There's significantly less on the offer side. Trader B's order does the same thing as before. It's only half the size of the liquidity that's available at the bid, so it's absorbed and the price doesn't move. Supply exceeds demand. Trader A's order is again much bigger than the liquidity, on the offer side, despite the fact that the order itself is exactly the same size as trader B. So it still eats through the limited liquidity on offer at multiple price levels and the price moves up. Again, demand exceeds supply. Now in one scenario there, we had equal amounts of liquidity from market makers, but unequal sizes of orders from customers. In the other scenario, we had equal sized orders from the customers, but unequal amounts of liquidity from the market makers. And in both cases, the price went up. So what I hope you can see from that is prices don't necessarily move because buyers outweigh sellers or that sellers outweigh buyers. That's usually what you get told, that the prices go up when there are more customers buying than customers selling and vice versa. Bulls fighting bears and that constant tug of war battling for control. That's not the case. It's a nice story, but it's not true. Prices move because of imbalances between supply of and demand for liquidity. You could actually have more sellers than buyers and the price will still go up, as you can see from this example on the screen. So it's not just about buyers and sellers. Prices really move when customer demand exceeds the supply of liquidity in that direction. It is that interaction between customers and market makers, which is why I've been emphasizing over the previous 3 lessons, the importance of tracking dealing desks and market makers. What it's really saying is prices will move in the direction of least liquidity relative to demand. That is a mathematical certainty and it's an indisputable fact, and every economist on the planet will confirm that for you. It is just basic market mechanics, and this is where it gets really interesting. If you could identify when customer demand is greater than the supply of liquidity on one side of the market, you could predict with 100% certainty which direction the price was going to move next. That's a pretty exciting proposition because it would give you a 100% win rate with your trades. Now, unfortunately, the Forex market isn't that transparent. We can see a great deal of the customer side orders, as we'll discuss when we move on to the core volumes indicator tomorrow, but we can't see all of them, and it's tricky to know for sure whether the price change was due to a real transaction or just triangular equilibrium. But let me show you this scientific paper that was produced by 3 researchers at Stanford University. They found that by just measuring the liquidity volumes, they were able to predict the price direction 81% of the time. And this wasn't a small backtest either. They made 2.5 million observations to ensure that these were statistically reliable results. All they did was compare the amount of liquidity on the bid side to the liquidity on the offer side. If there was an imbalance, 81% of the time, the price moved in the direction of least liquidity. Now that's quite incredible when you consider they weren't able to factor in the customer side activity. They effectively only used half of the price equation by only studying market makers, not the dealing desks, and yet they were still able to correctly predict future short-term price direction 81% of the time. So what does that mean for us? Well, we're not trading with the high-frequency auto-rated algorithms and scalping fractions of a pip that the large institutions do and that were used in this research paper, and we're not measuring the full depth of market liquidity either. We've got a different set of resources. But using the same facts and market knowledge, we can be just as, if not more profitable than that. Remember that market makers profit from the spread. Now, in an ideal world, they don't really want the price to move. They want to buy and sell quickly before the price changes. They want to buy from trader A, turn around and instantly sell the exact same amount to another customer so that they pocket the difference. If they don't manage to do that fast enough, they can get caught out on the wrong side of a directional move. Now, contrary to popular belief, market makers have trading risks, just like us speculators. Several of them actually went out of business in 2015 when the Swiss National Bank unpegged the Swiss franc from the euro and the market just accelerated off for about 3,000 pips in less than a minute. So go back to my example from a moment ago where trader A's order was much bigger than the liquidity on offer and it quickly pushed the price up several levels. In that situation, the market maker is now on the wrong side of the market and suffering a loss. As soon as the price started moving up quickly, other market makers competitively stepped in to try and fill the gap with improved bids. So the bid is now higher than the price that he sold at. They have to accept losses like this sometimes. It's part of their business. They certainly don't want to add to it, They don't want to keep selling into this rising market. So what they do is reduce their liquidity on the offer side. And this creates a liquidity imbalance, which the Stanford University researchers established would result in a further price move in that direction 81% of the time. At the same time, they're increasing their bids even more competitively to try and attract a seller to them so that they can get out of what is effectively a losing position for a limited loss before it gets any bigger. The net effect is liquidity becomes even more reduced on the offer side, but more concentrated on the bid side. It's precisely the conditions that create an imbalance in liquidity either side of the market. And therefore, the price is even more likely to continue moving up. Price is mathematically more likely to move in the direction of least relative liquidity. We know that is a fact. So we've now got a self-perpetuating cycle that feeds on itself and it gathers more and more momentum. This is what causes momentum, the fast moves, the spikes in price that you see in the market. This is what's happening behind the scenes to cause that. When a big market order initially consumes the liquidity quite quickly, it creates a cascade effect as market makers reduce their liquidity to manage their own losses, which then exaggerates the liquidity imbalance and it speeds up the price move even further. Hopefully, now that you've seen that, everything else that I've been saying makes a little bit more sense. This is why it's so important to pay attention to the activity of the dealing desk customers and the market makers. By recognizing where these big players are and what they're doing, we're able to take advantage of extremely high probability moves that are based on facts, evidence, and reality. And we have enough information on the dashboard to be able to recognize the telltale patterns that act as a signpost pointing us to where the best opportunities are. So what I want to do now is try and put all of the pieces together that we've discussed so far over the last few lessons and translate that into patterns that you can read on the dashboard. You know all about the dealing desks, you know about the market makers, you know about the mechanics of price movement. So now let's show you what all that looks like when you're reading the dashboard. And I'll start off with a checklist of basic conditions that you can look for, and I'll explain how each one will stack the odds in your favor to give you better and better conditions. Most of these aren't necessarily in a specific order of importance, by the way, but I'll try and keep things in a nice logical sequence. Just bear in mind, I'm not teaching you a specific system here. I'm not drilling down to the core volumes and the bid-ask indicator on the individual charts yet either. All I'm doing here is explaining what patterns to look for on the dashboard, what they mean, and why they will give you an edge, especially when you combine them together with the other indicators later. So the first thing is trade in line with the session box. This is the top of my list in order of importance. It is always my number one rule. This can be set to start at an exact time of day, and you should set it to align with a financial centre whose hours you're trading in. I do my trading in the UK morning, so I set this to match 8 AM UK time when the London Forex banks open. Although Forex is open 24 hours a day during the week, it follows cycles where certain financial centres dominate the activity during their working day, starting with Tokyo during the Asian markets, then London, and then New York. When I'm trading in the morning, the Tokyo banks have finished and closed, and New York isn't open yet. So it's the London banks and dealing desks who are dominating and controlling the action. Therefore, I want to know what they're doing and follow them. So I set this to match the start of their day, and I can see exactly what they're doing in terms of which currencies they're pushing up to strength and which they're pushing down to weakness. This horizontal line is the zero line. That's the value of the currencies as they were at the open, and that acts as my point of reference. Any currency above that line is stronger than it was when the London Bank started work. Any currency below that line is now weaker than it was when they got started, and I will never ever trade against that. I'll never sell a currency that's above the zero line. I'll never buy a currency that's below it. Without fail, that's the rule that gets me into more winners and keeps me out of more losers. The second most important element is the session liquidity box. This can also be set to start at an exact time of day to match the major financial centres. So again, I set this to match just the London morning, but you can set it to cover the full day, including the afternoon, for London, New York, or Tokyo, or even the full 24 hours. It really depends on when and how you're trading. In any case, what you're looking for is good liquidity. Now, I won't repeat what that is or why it's important because I've covered that in the last lesson, but in simple terms, I use this to determine whether the overall conditions today are good or not, and I will only trade if they are good. If this was just a wall of red and we were seeing 50% below average liquidity, I wouldn't even contemplate entering any trades. Now, the reason these two factors are my two top rules is because they keep me on the same side as the two main market participants. I can see a bird's eye view of what the dealing desks are doing and the market makers in general. It doesn't matter whether you're an intraday short-term trader or you take longer-term swing trades that you plan on holding for weeks. When it comes to actually timing your entry, you should always take into consideration what the dealing desks and market makers are doing right there and then during the session that you're thinking about entering on. It makes absolutely no sense at all to enter a trade in the opposite direction to what the big banks are doing right now or when market maker liquidity is very low. So those are the two most important top level starting point filters. Once I'm happy with that bird's eye perspective, that's when I can drill down and look in more detail at other patterns on the dashboard. As I said in lessons 1 and 2, individual currency strength and weakness is the most valuable indicator that we have, and it gives us the biggest boost to our edge. So let's look at some of the details that separate the best patterns from perhaps some of the lower quality ones. The absolute strength and weakness is the obvious first point. So this is technically a strong currency and this is technically a weak currency. But what's the real imbalance there? There's almost none. If you remove that zero line, these would look more or less like they were flatlining, yes? Think about what that must be meaning is happening in the market for those two currencies to be where they are. In all likelihood, these are being pushed around by triangular equilibrium rather than real orders. Whereas these two are much more dramatic. They're much further apart and therefore they have much bigger imbalances between their values. For them to be that far apart, it's much more likely that real order activity was taking place. So the distance between currencies is important and it's a valuable clue to differentiate between the probable real order activity or lack thereof. And closely linked to that is the correlation between them, or whether or not there's a mirror image. If one currency goes up and the other one goes down an equal and opposite amount, it's very likely that real orders are being transacted on that pair. And the closer to a mirror image you have, the better that pattern is. Now, with experience, you're going to be able to eyeball this and assess it just from looking at the strength lines. But don't forget, you also have the mathematical value available in the ticks details page of the dashboard. And what you're looking for is a high negative value. A high positive value means they're doing the same thing. And the chances are you wouldn't even consider those currencies anyway because they'd probably both be weak or both be strong. What you've got to be careful of, though, is the negative correlations that have a low value. And by low, I mean anything under 50%, really. We've got an example of this from lesson 2, where I showed you the conditions in the market while I was preparing that lesson. The euro was obviously moving to weakness. And on the strength side, there were a few options. You had the US dollar, the Canadian dollar, and the Japanese yen. Now, the yen and the US dollar are usually quite closely positively correlated during the London session. Where one goes, the other one tends to follow. And looking at the currency lines back here, you may have thought they both looked like good options to pair against the euro. But the correlation values tell you a slightly different story. The euro and the yen were only negatively correlated 22% of the time. That means they only moved in perfect opposite directions 22% of the time, whereas the euro and US dollar were negatively correlated 76% of the time. Now that is a massive indicator that there are more real orders on the euro-US dollar pair, and the euro-yen pair is more likely to be moving thanks to, or more significantly from, triangular equilibrium. Now, having said that, the negative correlation by itself is not enough. You would also want to look for the smoothness of the lines. Now, here's a really exaggerated example of that. These two currencies would have close to 100% negative correlation. It's a near perfect mirror image, but that does not offer you a high probability trading opportunity. Those currencies are volatile and they're reversing their direction too much. A condition like that is probably down to a lack of liquidity, and we'll talk about that later. But what's important is there are bad conditions there. that would most likely cause you to get stopped out for a loss as that price whipsawed back and forth, despite the fact that they would have a great negative correlation. What's more important is that the currencies are moving opposite to one another, but fundamentally in a consistent manner in one direction. These two would also have a very high negative value, close to 100%, because they are, again, almost perfect mirror images of each other. But these conditions, hopefully you can see, are vastly more favourable. If we just split them down and look at the individual currencies, and that's got to be the one thing that you always come back to, because ultimately that is what we're trading, each currency is that market by itself, and which one would you prefer to trade? Which do you think has the better conditions and the better trend? Remember, it's the trend that we're looking for. Think about what's going on behind the scenes there. To create the pattern on the left, whoever or whatever is driving those moves is flipping back and forth. One moment conditions favour a move up, the next moment it's a move down. Whereas the pattern on the right is consistently going in the same direction. The conditions are nice and established and determined, and that is a much safer move to be involved with. So always consider the smoothness of the lines as well. You're never going to get perfectly smooth lines. There's always going to be some fluctuation and choppiness, but the smoother the lines, the better the conditions and the more probable your trade outcome will be. The final pattern on the currency lines is momentum. We've just talked about this in the lesson, so you understand what momentum is in terms of price mechanics, why it happens and why it adds to your edge, and the way it appears on the currency lines is steepness and speed of the move. These two currencies are moving away from each other quite nicely. They tick most of the boxes on our checklist. The absolute distance between them is pretty good. They've got a good mirror image, good negative correlation. The lines are reasonably smooth. There almost certainly are real orders driving that move. But right now, there isn't actually any momentum. This is just a slow, steady plod. Now look at this example. It's got the exact same basic conditions, but now there's also momentum happening right now. The telltale pattern is the steepness of the lines. These lines are moving further and faster. It's a bigger price move over a smaller period of time. Now, momentum like this one is one of the highest probability patterns we have. It is the most reliable pattern that tells us when the biggest imbalances exist between customer orders and liquidity. Momentum tells us when demand outstrips supply and the price is rapidly moving in the direction of least liquidity. When those researchers at Stanford University identified imbalances in supply of liquidity, they were able to predict short-term price direction with 81% accuracy. Momentum is the signpost in the market pointing us to those kinds of imbalances. And with this pattern, the more exaggerated it is, the better. And you really can see moves like this sometimes where the lines are nearly vertical. Put all of those factors together, you've got excellent trading conditions. And that's only looking at the currency strength lines. We can then add pip, tick, and liquidity patterns on top of that to be even more selective of the best conditions. I haven't even talked about the pip indicator so far, of course, but the patterns you look for here are identical to those that I explained in the ticks and liquidity when we talked about that in the last lesson. An ascending staircase pattern means conditions are improving, and a descending pattern means that conditions are dropping off. The pips indicator is measuring the absolute price moves, not relative. Remember that I explained that the currency strengths and weaknesses were measured in relative terms because a 5 pip move on one pair may represent the same percentage change in value as a 10 pip move on another pair. And it's the relative strength that we're interested in because it is a more accurate representation of the true value when we're assessing one currency against another. But measuring the absolute pip moves as well is valuable when you're assessing a single currency for the same reasons we look at ticks and liquidity on the main interface of the dashboard. We want to see if the currency is more active now compared to the average. That's really what all three of these indicators are showing you, whether the conditions are getting better or worse. When liquidity is increasing, it means market makers are becoming more active and more competitive. That's a good sign because they become active in response to increasing customer demand. The same is true of ticks. Increase in tick volume tells us there are more orders taking place. Increase in pip values are good because they tell us the imbalance between demand for and supply of liquidity is getting bigger. It must be. For the price to move further than average in the same period of time, it means customer orders are exceeding the supply of liquidity. Price is moving more quickly in the direction of least liquidity, one of the most important edges we have in the market. Increases in pips, ticks, and liquidity are actually all tied in with identifying momentum, but especially so with pips. Increase in pips is directly related to the pattern of momentum, and it helps us identify it much more easily. Now, there's one final element that will add to your edge, and that is the bid and offer imbalance indicator. That's these red and green bars inside the ticks indicator columns. This gives us a breakdown of how market makers are adjusting their liquidity. It's basically the same calculation as the bid and ask indicator that I showed you in the introduction webinar that you attended and that we're going to talk about in the next lesson. But this version looks at the individual currencies in isolation and shows us 3 different time frames side by side for comparison, whereas the chart-based indicator shows us the comparison for the pair chart that it's attached to and only on that price bar time frame of the chart. So let me just explain. This is the typical setup of the market with bids and offers either side. And for this example, we'll just say that the liquidity is balanced equally either side, but we have more buying customers than selling customers. As those customer orders take the liquidity on the offer side, the price starts moving up. And look what's happening to the offers. Initially, this is the best offer in the market. When it gets taken, this becomes the best offer. And when that gets taken, this one becomes the best. Each one is progressively higher or worse than the last. Now, on the bid side, it's different. As the price starts moving up, the gap between the bid and the best offer widens. There's a gap in the market, and market makers will fill that by submitting a new bid higher up above the previous one. And as the price keeps going up, market makers keep putting in new bids and following the price up. Each new bid is better than the previous one. It's an improvement. That is a completely normal situation and one that you would expect. And what it means is in a rising market, market makers typically improve their bids while their offers get worse. If we counted every time a market maker improved a bid and every time they improved an offer, and then we compared those numbers side by side, in a rising market, we would expect to see more improved bids than offers. And in a falling market, we would expect to see more improved offers than bids, because the situation is just the reverse of the example that I just gave you. And that's what this indicator is doing. It's counting every time a market maker improves a bid and every time they improve an offer. Then it's measuring them against each other. And if the red column is bigger than the green, it means there were more improved offers. And if green is bigger than red, it means there were more improved bids. The time periods that are being measured are exactly the same as the parent tick column bars that are displayed in. So the left column is the value over the session from the start of the day. The middle columns are the recent past, that could be the last hour, 10 minutes, depending on what you set this to. And the right column is then the shortest period, like perhaps the last 10 minutes or the last 60 seconds. Again, it's up to you. And these are absolute values. They're not averages. The importance of this indicator is as a filter to avoid low probability trades or a confirmation to get into really good trades. You know, let's say you were considering a buy on the euro because the price was rising like this. Well, under normal conditions, you would expect to see the green bar bigger than the red. That would mean market makers were adjusting their liquidity normally and following the price up. They're reducing their liquidity above the price, adding more below it, therefore making it easier for the price to rise further and harder for it to reverse and go down. This is just basic price mechanics that we've discussed earlier in this lesson. So if you see an imbalance with more green than red, you've got a confirmation of good conditions. And the bigger the imbalance is, the better that confirmation is. However, if you were considering that buy trade and you looked at this indicator and saw the red bars were bigger than the green, that would mean that the market makers are doing the opposite of what they normally do. They're actually adding more liquidity above the price than below. That makes a continued move up much more difficult for the price because it's effectively rising into increasing liquidity. If you were to see that situation, well, you should avoid that condition because it's a low probability condition in the market. This is a real insight into market maker behavior, and it takes our liquidity analysis to an entirely new level. You always want to be trading in the flow with price mechanics and going in the direction of least liquidity. Follow the price along its easiest route. Remember, we are going to discuss the chart-based version of this in the next lesson. It does exactly the same measurement, but instead of showing you 2 bars, it just shows you the net value. If the green bar was bigger than the red like this, it takes that net difference and then it displays that color below the price bar. So this would be all of the conditions that are present at the same time that we've just gone through there. You want a strong currency matched against a weak currency during this market session, be it London or New York, etc., whatever you're trading. And you want the currencies that are moving significantly away from each other with a sizable difference between them. You don't want to pick currencies that are really close together. They should have a good mirror image and negative correlation. You want smoother lines rather than choppy or zigzagging. You want to see steep, fast moving lines because this represents momentum. The market session liquidity should be good, preferably above average by a significant amount. So mostly green here. It means there are a lot of customers trading today. The individual currency liquidity should be increasing in the ascending staircase pattern because that shows us that market makers are being much more competitive and active. You want the same pattern on the ticks because this shows us there are more orders being submitted from customers, and the pips column should also be the same because this indicates an increased imbalance between customer orders and supply of liquidity, which leads to more momentum. And finally, you should have more improved bids compared to offers on your strong currency because this indicates increase in liquidity below the price and decrease in liquidity above it, and obviously vice versa on the sell currency. If you can tick off everything on that checklist, you've got really good high probability conditions in the market that are much more likely to result in a favorable trade. You've stacked the odds significantly in your favor and given yourself an edge that will make you money consistently from now on. Now, there are, of course, lots of other things that be considered. We've got different time frames for starters. We can do more analysis on the tick data pages. Different times of day can be important to consider. Different pairs matter. We've got moving averages for each currency we can use. And most significantly of all, we've got the core volumes and the bid and offer imbalance indicator to consider. The customer core volumes especially is one of the most important tools you could ever use that other retail traders have never been able to use before because I said this is the only tool that actually taps in to level 2 data direct from exchange floors. So this is a really complex suite of tools that can do far more than what we've covered so far today. But of course, it's unrealistic to try and teach you everything in a single lesson. If you just think of this as driving a car, this is the steering wheel of a Formula One racing car. Now, to say that is a high-performance, complex piece of equipment is an understatement. It's capable of making a car perform more like a fighter jet. And to get the most out of the car and win world championships, you do obviously need to use every single part. But just driving a car from going A to B, well, you really only need something like this or this part of that steering wheel. And that's what it's like with this dashboard at this stage. Of course, it's capable of everything you're ever going to need, and it can help you excel at the very top of the market with any system or strategy that you desire to use. It's as advanced as the most advanced trader that's using it, but it will still help you make money even with the most basic functions in the hands of the newest of traders. And my aim is to teach you to make money quickly, easily, and reliably. And for that reason, I am deliberately starting you off at the beginner level. Trading is simple when you do it right. And when you use the main features of these advanced analysis tools, it's really hard to get wrong, actually. Now, if you decide after this course that you do want to use these indicators in your trading from now on, you're, of course, going to be able to learn much more, and you will gradually exploit all of the advanced features as you gain more experience. For now, though, on this course, I just want to keep it as simple as we can. Okay, so let's wrap this up, ready to move on to the next lesson tomorrow. There's really only one summary point that I want to emphasize from today's lesson, and that is the price is more likely to move in the direction of least relative liquidity. Everything we do, every pattern that we look for, every condition that we're trying to recognize is geared towards that one fact. And it is a fact, a mathematically irrefutable fact. The price is more likely to go in the direction of least relative liquidity. Your edge and your ability to reliably make money predictably and consistently lays in your ability to identify conditions when customer demand exceeds liquidity supply. When you find those conditions, you can predict the future price direction with a reasonable amount of accuracy. Tomorrow's lesson is going to move on to the core volumes and the bid and ask indicators directly on the chart. And those two combined with the information on this dashboard are the most advanced and reliable way you can identify the supply and demand imbalances available to retail traders. I'll leave it there for now. I hope you've enjoyed this and you are now a little bit more excited about the many possibilities that level 2 analysis opens up to you. I probably don't need to tell you to rewatch this lesson because I'm hoping you were going to do that anyway. Thanks for your time as always, and please look out for the link to the next lesson tomorrow. Thank you.